Okay, I'm very happy to have on the show Neil Irwin, who is a senior economic correspondent at the New York Times. In fact, he's sitting in their Washington bureau as we're talking, and he wrote a book which I read called The Alchemists, Three Central Bankers and a World on Fire, which was about how the central bankers around the world really tried to deal with the crash of the markets in 2008 and its aftermath. Neil, a real pleasure to have you.
Thanks so much for having me.
So in your book, you portray the central bankers as the ones who solved the problem. That was the feeling I got from reading your book. But weren't they kind of the ones who really caused a lot of the problem by allowing interest rates to go so low that it created a bubble in the real estate market?
Yeah, I think there's something to that. With great power comes great responsibility, they say. And the power that the central bankers deployed during 2008, if it had been used in a more savvy, thoughtful, forward-looking manner a decade ago, might have maybe not prevented the crisis, but certainly could have mitigated it and made it less severe and made it not something that would have such lasting consequences that we've seen since 2008.
So I'm not. The point of this interview is not to put blame on them, because I'm really, I, from what I could tell from all the people I read and everyone involved on both sides of the aisle, people really were trying to solve the problem. But with hindsight, you're suggesting that had they known 10 years earlier, they just would have done things different?
Yeah, and I think the big difference is less on the monetary policy side. Did the Fed keep interest rates too low in 2005 for too long? Well, maybe. I really think that the broader problem that led to this crisis was being insufficiently worried about some of the imbalances building in the global banking system and in the global financial system. That means the rise of over-levered banks across a lot of the world, including the U.S., Europe. Also, the rise of a shadow banking sector, a non-bank sector that was really creating all kinds of risks in the economy that regulatory pressure might have been able to contain some, but to the degree that the central banks are also regulators, they were not leaning ahead of those risks and trying to keep them from getting out of hand.
So let's focus a little bit on one of the main issues related to what you're saying, which is the regulators are always going to be behind. They're always going to be behind at times because, well, let's face it, they're government regulators. There's a limit to what they can do and what they can regulate. Had they allowed for greater transparency, so people really understood what was going on, wouldn't that have allowed everyone to be a regulator? And because everyone who's investing in the bankers, both professional and non-professional, could have seen what was going on with the banks?
Yeah, I think there's a good argument that, as you say, regulators can't prevent the world from every risk that emerges. There's always going to be failure in a market economy. There's always going to be institutions that make bad decisions and lose money. The key is you want a world in which, some bank making a bad loan doesn't blow up the entire global economy. You don't want a world in which a Lehman Brothers or a Bear Stearns or a AIG or any European bank can by failing cause these tremendous economic ripples that have caused all these problems across the world for the last 8-9 years. And so I think that should be the goal of whether it's central bankers or any other government official, trying to create a system that's resilient to shocks and problems that are inevitably going to take place.
Well, how about just not being the one to bail out the banks who take these unbelievable risks and letting it actually fall on the shareholders?
Well, so this cuts both ways. So on the pure bank bailouts, those are often more fiscal decisions. In the United States, it was the TARP legislation that Congress passed. We can debate that over and over whether those were good ideas. There's been a more recent debate on what should happen with Italian banks in Europe. Those are important, interesting discussions. I would argue that a lot of what central banks were doing during the crisis was less that kind of bailout, less injecting money into banks, and more being the lender of last resort, which is a classic responsibility. Walter Bagehot was the great Bank of England governor in the 19th century who founded a lot of these ideas that a central bank should be ready to lend when nobody else does and backstop the financial system with loans that are secured, that aren't just flinging money and giving money to banks, but instead loaning money at a discount and with good collateral to keep the entire system stable.
We're talking with Neil Irwin, who is at the New York Times, and he's also the author of a book which I highly recommend called The Alchemists, Three Central Bankers and a World on Fire. We've been talking a little bit about the run-up to the failure of the banking system or near collapse of the banking system, not only in the U.S., but around the world in 2008. Now, let's try to simplify this a little bit. Let's talk about what a bank, what I understand a bank to do. And I don't claim to be a professional. I am in the money business. In my day job, I'm a financial advisor. But I understood growing up that a bank gets money from depositors, just like you and me. We put our $100, our $1,000, our $1,000,000 in the bank. That money's available to us because it's short term. The bank is then supposed to take that money and lend that out to other people or companies for longer term loans. And if everything fails, the government comes in and would be the lender of last resort. Is that a fair summary of what most people think banks do?
That's about right. Yeah, I mean, what you're describing. So the technical terms for it is liquidity transformation and maturity transformation. So all it means is liquidity.
Right.
Think about it this way. So you can go to a money machine and take money out of your bank account anytime you want. You can write a check. You have that money any moment you might need it. But at the same time, what the bank's doing is using those resources collectively from all depositors to make long-term investments, to lend to companies that are building a factory, to lend to people buying a house. And so it's turning this short-term money that you have access to all the time into long-term investments. And that's a pretty magical thing. I mean, I call my book The Alchemists. It is a form of alchemy when you get down to it.
So what if that's all it was, and if we could get back to that, maybe I would think that we could all feel pretty confident in the banking system. But what was different in 2008 that made that system fail?
Well, the difference is there wasn't enough capital in the system. So, capital is the gap essentially between the amount of money banks have loaned out and the amount they have on deposit. And the more capital they have, the more cushion they have. So there's some of those loans go bad, the bank doesn't go under. They can still repay their depositors. Yeah, their shareholders lose money, but the entire system is stable. Now, in 2007, 2008, banks were very undercapitalized. I think most people would agree. That's why so many global banks, whether it's Citigroup, whether it's Deutsche Bank, had such trouble, why there were so many bailouts. Now there are much stricter capital rules in place. The question is, are they high enough? Do we now have a world where banks will be resilient even if they encounter major losses on something bad that happens?
So who's the one who's deciding if they're high enough?
So that's all the central bankers get together and other bank regulators in Basel, Switzerland, and they debate these things and try and come up with a framework of how these rules should work and try and make them coordinated across borders. So, you don't want a world in which a German bank has very different capital requirements than a U.S. bank or a Japanese bank or an Israeli bank. You want some sense of kind of a level playing field so that you don't have all the money slushing toward one place with the loosest rules. So that's why the regulators all get together in Basel and try and hammer out what those ought to be.
Mm-hmm. And those people they're not influenced by politics. They're not looking for jobs at Goldman Sachs when they finish their government work.
Well, they're definitely influenced by politics. I mean, these are, in most cases, appointees of prime ministers, of governments. They are responding to their national interests and their banking sector's interests. So you see these battles on, one bank. Banks in Germany might prefer this set of rules. Banks in Italy prefer this set of rules. Banks in the U.S. this set of rules, and they hammer it out and try and find compromises. You can say that's good because that's them representing their country and representing democratic goals. That can work against the cause of kind of having the most stable financial system possible.
Mm-hmm. What if you and it sounds to me like the government is sort of like the insurance company for the banks. So let's say that you and I opened up, Irwin and Goldstein Insurance Company, and we said, we're going to start insuring banks. And there were other guys around who decided to open up insurance companies to insure banks. And then we had a competition to say, okay, listen, we are really safe. And we're going to demand that our banks have 50%, on deposit in case there's any problem. And the German company may say, we want 60%. And then, the Israeli company might say, we want 70%. But one company is going to say, we only want, 20% of the money on deposit. And everyone knows what's going on. Wouldn't that allow individual investors as well as corporate investors to say, wait a second, the guys in Australia are really running a little bit too free. I don't want to put my money there because it could collapse, and they'll see what's available in terms of what's safe. And whereas you described, well, everyone should have a level playing field, I'm thinking as long as everyone knows what's going on, people can make their own decisions about where to put their money that actually is safe, because there's a limit to how much a government can really bail out a bank.
Well, the problem, though, is that ultimately, I think what depositors around the world understand is that a nation's government really does stand behind its banking system. And, when that isn't the case, it seems to create very bad ripples. That's what happened in the Great Depression when banks failed without a backstop. Fundamentally, people want to know that their money they deposited in the bank, they're going to get back. And what we've seen around the world is governments step up and do that when it comes down to it. And so, the problem is you might say, oh, let's let the market work and people will only put their money in safe banks. But if when it all hits the wall, if people know the government's going to be there, that market discipline doesn't really work. It kind of breaks down.
Mm-hmm. So you're just saying that people need the government because they're just going to make bad decisions, and then when they really do need to get their money out of the bank and there's nothing there, they're going to come crying to the government, and we'll have a Great Depression kind of scenario.
Yeah, and we've seen that. This economic history is full of these episodes. In the United States, it used to happen every few years in the late 19th century, early 20th. That's why they created the Federal Reserve System. The Great Depression was, it started with just a minor stock market drop in the U.S. And then that spread through the global banking system to become this profound crisis that caused 25% unemployment, caused the rise of the Nazis. Having a stable financial system is important to having a stable economy and really to having a stable political system. And so it's very dangerous when there's this kind of chaos in the financial system, which is why the central banks did what they did back during the crisis.
So are you optimistic that the subsequent legislative changes and procedural changes are enough to protect us, that this won't happen again? I know you can't predict a different problem, but at least this problem.
Yeah, that's the thing. It's never the last crisis that happens again. Do I expect we're going to have a housing bust and a housing bubble that causes a bunch of investment bank failures that ripples out across the world and causes another huge recession? No, the next crisis will happen some other way. We're already seeing evidence of a kind of political crisis in Europe. So there's plenty of risk out there. I think that the risks are different from what they were 8 years ago. We just have to hope the entire system has become more resilient and that we're not at risk of these downturns and problems in the financial system really bleeding over into the entire world economy.
Okay, I'm not sure I'm taking away a really optimistic tone from you, but I'm hoping that your book and what you're talking about and all the central bankers listening to today's show are going to say, we should probably be a little more careful because we're the ones who are ultimately responsible for making sure that the banking system is stable. We're just about out of time, but in the last few seconds, tell people how can they follow you and follow your work?
Go to nytimes.com/upshot to read economic and other analysis at the New York Times. It's the Upshot website.
Okay, we will put a link to that at the show notes of today's show, as well as a link to your book, The Alchemists, about the Alchemists, 3 central bankers and a world on fire. Neil Irwin, thanks so much for your time.
Thanks for having me.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.